Hello, everyone, and welcome to the very first episode of Ticker Talk. It's been a long time coming. We've been working on this project for multiple months now, and we're super excited to finally bring to you our first episode. And I guess today, what's going to be really interesting is we're going to walk you through kind of the structure of what we want these podcasts to be, but also already bring in our first guest, which will be a part of every show. We're going to try to bring in, external guests, internal guests from Fidelity, keep the show light. But definitely provide insights and, just to give a bit of background on kind of what we're looking for here and what to expect going forward. And we're going to have these 30-minute monthly podcasts focused on the Canadian ETF industry. We're going to, once again, bring in guests like I had mentioned, but we're also going to answer your questions. So that's a really exciting part of the show for us, whether that's through Reddit, whether that's through submissions that we have from investors directly. We're going to take the time to answer any types of different questions with regards to ETFs, whether that be on industry trends, whether that be on certain types of products, investment styles, markets. We're going to try to get into markets as well, but obviously with a little bit of an ETF bias. This podcast is called Ticker Talk. But maybe before we kind of dive into it, introducing myself a little bit. So for those who don't know me, my name is Étienne Joncas-Bouchard. I'm the host of the podcast. I've been at Fidelity for close to 8 years now. I'm a father. I like to golf, love sports. That's pretty much it. Pretty simple guy. But with that said, I think the objective, like I mentioned earlier, is to give you guys an idea of what we're going to be bringing to you. So there's going to be 3 segments to each episode: industry recaps, answering the internet, and then guest interviews. So the first 2 segments are generally going to be run by me. Maybe we include the guest in answering the internet. But for the most part, that's going to kind of be like a one-man show, if you will, to start. And then, we're going to be bringing in a guest. So for today, that's going to be Sébastien Faucher. So he is a ETF strategist here at Fidelity, and he'll come share some insights into what he does on the daily basis, things that he's hearing on the streets, and things that you can apply for your own portfolios. So that's going to be very interesting, I think. So let's get started. First part, as I said, industry recap. I think so far this year has been a really interesting year for the Canadian ETF industry for a few different reasons. First of all, if we look at just the overall growth of the Canadian ETF industry, it's still in very rapid acceleration. Last year was a record year, talking more than $70 billion in net new assets going into the Canadian ETF industry. So that's, retail investors like myself, like your parents, like your family, coworkers, as well as institutions, so like bigger investors, right? So you can think pension funds. So it's been a very rapid growth year. We're up to more than $40 billion in net new assets as of the end of May. But really, the reason we're doing this segment is so that you can get an understanding of what other people are buying and why is that actually important to you, right? So why would you want to know what others are buying? Well, it gives you an idea of what's trending. Are there any new things that are happening? Any new launches that have come out? So the new types of products, we'll also entertain some of those as we go through. Some of the main key drivers I'd say this year, first of all, is as Canadian investors, and I'm sure many of you know this, we do have a bias towards stuff that we know when we invest, right? So we tend to own more Canadian stocks than anybody else in the world, which is totally normal. That's something that we see in the US, we see in Europe, we see in Asia. There is a domestic bias by Canadian investors, but over the past year, we've actually seen Canadian investors allocating more and more outside of Canada, whether that be, in US equity ETFs, US bonds as well can be bought through ETFs. And more recently, it's been towards the international equity sleeve of portfolios that has been growing. And in international equities, to give you an idea, that's pretty much everything outside of North America. So that's Europe, and we're talking developed markets, not emerging markets, albeit there has been demand for emerging markets as well. But that category has really taken off this year as the performance of those markets have clearly been better. But it's a market that's also had a bit more of a challenge over the past 10 years as we've seen some type of U.S. exceptionalism, some call it, that so many companies have done significantly better in terms of performance based out of the U.S. And that is heavily driven by, obviously, we've seen technology, consumer discretionary stocks, communication services. Those are heavier sectors in the U.S. And a lot of the largest companies in the world in those sectors that are competitive are based out of the U.S. Hence, the strong performance that we've seen there. Obviously, the earnings growth that followed, they've done well for a reason. Let's say that. Let's put it that way. But for international markets, that's kind of turned this year. It was really interesting as there was maybe a bit of concern around a changing political landscape in the U.S. I guess a return to an interesting political climate, if you will, in the U.S. There seems like there was demand to diversify away from the U.S. as well as Canada, and that's really, I think, the main key point that we've seen so far this year that is relevant to you as Canadian investors. So to think outside of our borders, to diversify your portfolios. Another key point, I guess, that we could mention is during the period of April, which was a lot more volatile, we saw people going to cash, right? And something that we see often and often, time and time again, as markets get volatile, we generally see investors go, I don't want to say flee because maybe that's not the right word, but I will say go to the sidelines, right? So kind of wait for the period of volatility to disappear. But generally, by the time, markets have rebounded, the money's still sitting in kind of those lower risk type investments. So this was another great example, as it was in March 2020, that, trying to time the bottom for markets is extremely challenging. And we've actually seen in May so far, the things that are, being bought the most is just S&P 500 type ETFs, US equity ETFs. Here at Fidelity, it's been our equity ETF portfolios, the all-in-ones. We've also seen demand on our international equity products and such. But all in all, the risk on has kind of come back in May, but wasn't really there for a few months. So lots of buying of cash alternatives and things of the sort. That's pretty good for the industry recap. I mean, I'll answer a little bit of the stuff that we've seen, from questions coming in. But, not too many comments with regards to the US industry. We like to focus on Canada. So, but there has been obviously a lot of, how could I say, similarities between what's in demand in the US and what's in demand in Canada, albeit the US market is significantly larger. And obviously they're definitely not buying Canadian equities. So yeah, let's get to answering the internet. So I took a poll, a list, and we try to compile interesting questions every month that we can answer to make sure that we're following the feedback that we're getting from our viewers, our listeners. And so far I've compiled about 5 of them. But every show we're going to have different ones. So please, share them, whether that's on Reddit, like I said, or to us directly. So the first question we got was, some ETFs barely have any volume when I look it up on my trading platform. Does that mean that I might not be able to sell at any given time? It's a very good question. It's a question I get all the time. The volume that is shown on your, whether that be on a discount brokerage platform, or if you're an advisor on, your trading platform, is not the true liquidity of an ETF. And I think that's a common myth because so many investors are used to trading stocks, right? Where there is a fixed amount of liquidity. There's only a certain number of shares for each company. So if they're not trading, if there's no volume, that generally means less liquidity. So getting it out can be more challenging, or the actual cost, the spread, will be larger. Similar concept to ETFs, except that similar to a mutual fund, we can create and redeem units of the ETF, right? Which basically means we can create liquidity that's not being exchanged. The volume only represents what's changing from hand to hand. So investor to investor, advisor to investor, advisor to institution, etc. But that's basically trading from one hand to another. Whereas, like in the case of creation or redemptions of units, we can just basically create that volume for you. That's done by the market makers, not by the asset managers themselves like Fidelity, but the market makers that help make the ETF market very efficient. So great first question. When I look for dividend ETFs, I simply look for the ones with the highest distribution yield. Does that approach make sense? It might for some investors. That's not something that it's something that we hear also, right? A lot of investors Canadian investors specifically love dividends. You love getting, cash at the end of each month, at the end of each quarter, to use that to then reinvest, buy more shares, buy more units of your favorite ETFs. The one thing I would be cautious about for screening for yield is it doesn't necessarily mean because it's got a high yield that you're actually earning Canadian dividends or earning foreign dividends. It might be that you're also receiving return of capital. and I won't dive too deep into what return of capital is, but it's pretty much self-explanatory. Is there some ETF issuers and asset managers will actually return your own capital to you by the way of a dividend. Now, that's not a real, income generating source. It's literally just giving you your money back. So be careful of that note when screening for yield on certain products. Why are ETFs cheaper than mutual funds? Well, it's a tricky one to answer because I think the question is, why is passive management cheaper than active management? One of the, most ETFs, and this is more than 60% in Canada, more than 65%, I should say, in Canada, are passively managed. And what passive management means is you're replicating an index based on one metric, which is the size of the company, market cap. That is, generally speaking, a strategy that's very easy to employ and to run as an asset manager, hence why the lower cost, right? When most people think of mutual funds, it's because they're associating it to active management, right? And active management obviously requires significantly more resources, as you have fundamental analysts, fundamental portfolio managers that are not only going the extra mile to do their research, but they're actually physically meeting with executives, with companies, to learn more about businesses, to find the best investment opportunities, and to create their ideal portfolio based off of their research, which is often looking at profitability metrics. It's looking at valuation metrics, various different characteristics that they can attribute and compare one stock from another. So that costs something, obviously. But I wouldn't go to say that ETFs are cheaper than mutual funds. It's more that passive management is cheaper than active management, because you can have active ETFs and you can have passive mutual funds, albeit those don't really exist much anymore. But passive investing started as mutual funds way back in the 80s. Many people maybe don't know that, so a little tidbit, I guess. Here are a few that we got more specifically to Fidelity. This is from Reddit, and it says Fidelity's ETF, all-in-one equity ETF, so the ticker FEQT, employs factor investing strategies. How does this active approach compare to the passive strategies used by other ETF portfolios? This one could take a long time to explain, so we'll try to keep it short. But factor investing strategies, I also just kind of described the difference between passive and active. Factor is kind of in the middle. The objective is to systematically buy companies based off of metrics that our portfolio managers look at and care about, and that have shown over time, statistically, academically, to add value, right? Like if we constantly buy stocks based off of, lower price to earnings, lower price to book, higher free cash flow yield, lower EV to EBITDA value, basically, right? A value factor, you will generally outperform over the long term. And this is looking at like 20, 25, 30 years of data. It doesn't work all the time. That's not if it would, nothing else, we wouldn't need to invest in anything else. So they are very cyclical, but when you build them all together like we do in our all-in-one ETFs, it creates a really, really core portfolio, really strong diversification effect due to the sizable differences in the types of exposures you're getting between like quality and low vol, for example, or quality and value, which are really kind of offsetting risk profiles in from your equity sleeve. So that's one of the main differences, obviously, with other ETF portfolios in Canada, which are generally more passive in nature, especially the very big ones. So that makes us fairly unique. We also include cryptocurrency. What else makes some of the differences? We're more concentrated, right? Like we hold 2,000 to 2,500 holdings versus 20,000 plus for our main competitors. So I think that's something that's fairly unique. And each asset manager is going to have their own approach, albeit there will be similarities here and there. I will say that ours are fairly unique relative to other peers in the ETF category in Canada. And last question that we have, FEQT includes a small allocation to Bitcoin. Okay, well, I kind of mentioned that. There you go. What's the rationale behind this, and how does it impact the ETF's risk and return profile? Well, Bitcoin, as everybody knows, is fairly volatile, right? So I think the first consideration we had when including Bitcoin was, how can we potentially incorporate this volatile asset class to be beneficial for our overall diversification as well as return profile, or risk return profile for the portfolio. And what we found is that in a typical 60% equity, 40% fixed income, which is kind of the definition of a balanced portfolio for most investors, like how much Bitcoin can we add without basically creating an issue from a drawdown risk perspective. And what we found is you can go up to about 3%, right? And then after that, the volatility kicks in to an extent where it can take over and dominate the rest of the portfolio from a volatility profile. So we incorporated it back when we launched them, 2021. And it made us, I think, the first ETF provider to include Bitcoin in their multi-asset or asset allocation type ETF. So we were very excited about that. And I think the response has been great from investors. It's kind of the way that Bitcoin goes is, when it's going up, people tell us you should double your allocation to Bitcoin. When it goes down, you should take it out. We don't see it that way. We see it kind of as a long-term strategic holding in our portfolios. So that wraps it up for the questions for this month. Now let's bring in our guest. All right, everyone, welcome back. So we are welcoming our guest, first guest ever on Ticker Talk. Very special occasion for Mr. Sébastien Faucher joining us. I won't introduce him too much. I'll let him do that, but we're really happy to have you. So thanks for coming on the podcast. And I don't have a gift for you or anything because it's the first episode, but you got a cup of water. Maybe that'll do it. Thanks for joining us.
There's not even coffee in there, right?
No, water. Just water. But yeah, no, if you could just introduce yourself to our audience, kind of give them a bit of information on what you do on a daily basis and how you got here.
Sure. So I can start from the start, the real start, as graduated from university at McGill University in finance. Straight out of McGill, directly to Fidelity. It's been 8 years now. So I did a couple since a different department of Fidelity. But lastly, I was on the sales team as a wholesaler in Quebec City. Lived in Quebec City for the last 4 years. And I kind of wanted to go back on the more product side, development side, management side. So this new role, ETF Strategist, where it's kind of an intermediate where I'm part of the product team, working a lot in the product team, and at the same time, the sales team. So basically explaining those products and the background of those products with the sales team. So doing this since April now. It's been already 2 months and a half. Everything in the same time now, like just moving from Quebec City.
Kept you busy too.
Kept it busy at the same time. But yeah, it's a fun gig.
Yeah, well, that's awesome. And it's funny. It's like we talk about this on. I think we started on the same day or close to it. So yeah, we've been at Fidelity for a little while now. But it's great to have you on the ETF team. And I think for this audience in particular. We're talking to advisors, but we're also talking to do-it-yourself investors, and the objective of this show is to provide insights. And like, there's not many better people at Fidelity than our team, right? I think it's just because we're out on the road a lot, we're running around, we're talking to people, we're reading up all the industry news and things that are going on. So I guess my first question to you is, over those last 8 years, like, what's changed the most in your mind in the Canadian ETF industry, and maybe just like Canadian investment industry also? So like, we can broaden it out a little bit, but if you want to start with ETFs, whatever, take it away.
I think, well, as my previous role, right, I was meeting with brokers every day. Now also still doing it, but in a different manner. Yeah. The business. So what changed really in ETF is just the offering. Basically, there's way more offering, and it's going from what used to be only passive to anything,
a bit of everything,
everything right now. So you'll have we do smart beta, but you'll have some active, you'll have some covered calls, you'll have some private, you have everything. Leverage it, even interest in, like, instead of in your checking account, people are buying HISA just for their cash. So I think the main thing that changed is it actually starts from the broker side or the management side, where instead of using an ETF passive for maybe their stocks, they would do maybe their stock picking, or in banks, they do like their baskets. They have a specific basket of stocks, and then they'll use the ticker or the ETF to do something that is not within the basket. Yeah. So that's why I think the ticker is less and less passive and more quant or active, to give something that is different from the basket. Yeah. I think that's the biggest change I've been seeing over the last 3-4 years. And that comes to trying to offering. Yeah, and like fees, to your point, right? Like those baskets,
a lot of those names are in the TSX 60.
Exactly.
So, one of the biggest ETFs in Canada historically were some of the S&P TSX Composite and S&P TSX 60 ETFs. I mean, if you're buying those stocks individually, and maybe you don't have all 60 of them, but you got 15, 20 of them, like, it's pretty similar to your passive ETF to a certain extent.
Exactly,
So,
right? And it's the bank buys them. Well, if you work for a bank, the bank buys the product itself, so it gets a bit cheaper if you're doing it versus the ETF, or they, I don't know. So
yeah,
that's how I think that's mainly the biggest change in the ETF industry in the last few years. And now it just have so many options, and I'm sure you talked about Bitcoin in the past, but it's not only just quant and active, but also different categories. I don't know how they'll do it, but I wouldn't be surprised that even we'll have a kind of a private situation in ETF. Like, I don't know how they're going to manage the liquidity, but we're seeing in ETFs what we've seen in mutual fund at the start. So it's going to be exponential.
Oh yeah, and yeah, definitely. You're right. And there's a lot of innovation on the ETF side because it's kind of like a vehicle that's a bit more popular these days, if you will. Definitely among the younger generation. Just seems like it's easier to trade for the most part, right? So I think a lot of asset managers are looking to ETFs to innovate with like new products and stuff like that. Albeit there's also a bunch of new mutual funds that have come out since. But and
I want to, and maybe last thing I want to mention on this is like people used to buy ETF to reduce their fees.
Yeah, because they were buying a passive solution.
Exactly, right?
Yeah.
And now more and more people are buying ETF for the actual
strategy.
The strategy, right? Yeah. Which is a good sign, right?
Yeah. No, for sure. But I mean, at the same time, like you still see like some of the more popular ETFs, the large ones are, S&P 500 ETF, and those will remain kind of those big players, and understandably so. It's fairly simple, easy to understand.
Mm-hmm.
But you're right. There's so many other products that are available out there that can help build solid portfolios. The other thing I'll mention also is like there's a lot more tools and like resources you can find about ETF, like Canadian ETFs. Like if you want to learn about ETFs as an investor, other than like all the managers that manage the products, like there's so many different resources that you can go to, like TMX website, SIBO website, the exchanges. You can go on, CETFA, the Canadian ETF Association. There's so many different sources of information to help educate and navigate this bigger market or industry.
Even on YouTube, there's so much.
Right.
I mean, we're listening and watching a podcast now. If you're curious to know about how the ETF creation is made and stuff like, there's so much material.
How to trade ETFs. There's probably 100 videos of that online,
right? Because like ETF basically, the story of ETF got pretty much with the internet over the last few years and everything, right? So it's just
for sure.
Everything got developed also online, and there's so much data and information you can go see.
Didn't even think about that. Yeah. All right, second question. How can investors use both passive and active together? Because I feel like it used to be so black and white, whereas like nobody can outperform the S&P 500, or other people that were like, I found a great manager that has shown that it can outperform, and it was like one didn't like the other person, it felt like, or didn't respect the other person. But I mean, in our work with advisors, we've definitely seen that change. But like as an individual investor, I guess kind of what are the benefits of both, and how would you combine them together?
I saw something online, and they published a TV show from France, and the French TV show where they brought one active manager and they brought one passive manager, and they were not agreeing at all between the two. But I found it funny because basically both had the reason, right? Both were valid right arguments. In a certain value argument. So your passive investment will have way more core, will get you something that make sure you don't shoot yourself in the foot, follow the market. There's some, for example, S&P 500, the TSX. Some people just want the exposure for that, just the core, just to follow, just the beta. Exactly. Just get your risk to the market. And the best way to get that is through passive, which is the cheapest way to do it. Now, as Fidelity, we're an active management firm.
Sure.
We want to give the chance to advisor and investors to beat the market over time. And that's where active comes in, or quant also can come in. And by beating the market or outperforming the market over time, you can still have passive as your core, and then bringing what we call satellite around it to outperform over time.
Or like very unique investment strategies, right? And I think that's what's like heavily biased, obviously, but I look at our lineup and you can see like every manager we have has like a very different and unique investment style, where it's like, if I'm looking for this type of, manager, we have one probably. And this type of manager is very different, but also can accomplish their goal, which is to outperform the market, just doing it completely different ways, right? So
Perfect.
For each investor, to your point, is like, yeah, you can get your beta, but then you could probably find some managers that can align with the way that you like to invest with it, which is, it can be more risk on, it can be risk off.
Yeah.
So.
And a lot of managers now, what they do, or PMs in Canada, to reduce their risk of calls or predictions, they'll use passive for like 30, 40, 50% of their portfolio, which will follow basically the market. That's their beta number one. Mm-hmm. And then they'll go make their calls around it, right? But if they're wrong on one of their calls, at least they have a 30, 40%.
Yeah. Fair enough, for sure. It's a way to approach it. I mean, once again, to each their own, right? Like there's no right or wrong answer, I think, and that's the main message I wanted to get out. And thankfully, you did that. I wanted to make sure people think it's like there's not one that's the enemy, and that like they definitely work in tandem, and
that's why Quant got created, basically, right? So it's hybrid. It's a hybrid. It's the goal of bringing something that's highly correlated with the passive investment, but by still giving the chance to outperform the market over time.
And I think that's like the ETF vehicle is I think the vehicle that has the most, like you said, number of products, but also like you can get full on active, passive, obviously, and then you can also get like quant, which is in the middle. You can do all of that with ETFs. Whereas like I think on the fund side, it's a little more skewed, obviously, towards active naturally. But like we have some ETFs here, FINN, for example, our Global Innovators ETF, like that's managed by Mark Schmel, very high active share manager, very active product. I could say that for all of our active ETFs, but it just goes to show that like you can just buy that as a ticker now also, instead of going through, this is one that like I wanted to ask you because we're both around the same age, and there's a lot of friends come to me and ask me like, which ETFs should I buy? Should I look at dividend ETFs? Should I look at fully diversified ETF portfolios? Kind of like our all-in-ones. Like, do you generally point them in the direction of like just get like a one ticket kind of portfolio solution, or you're like, oh yeah, let's piece together these 4, 5, 6, 7 types of ETFs? I cheat and I kind of generally just go to say, let's grab this one ticket solution and then leave me alone. No, I'm just kidding. But is that kind of like, how do you see that? Like when you have those conversations, because like I get, just because we work in finance, so we work at Fidelity, so people ask us.
I get the question all the time. Like on the golf course this weekend with my buddies, they obviously ask me, what should I do? And they'll use these different platforms to buy the ETF. Obviously, my first answer would be, go see a financial advisor, go see a broker. Especially if they're at our age, they're starting to build more their assets, their wealth is coming big, is going larger. So that would be my first answer. But then yes, obviously, a one ticket solution. As soon as they're picking a lot of ETFs, I'd say you definitely need to go see someone, because like half of those you have no clue what they're doing. Like they'll buy the XXX on Tesla, or like the opposite. Like they'll buy anything, right? It's just for fun with whatever they see online. So definitely an all-in-one. And if I can't bring them to go see an advisor,
it's the next best option.
Exactly, right? And if I kind of sell them all-in-ones, or if I can sell them a fully diversified product. I had the question here, the person wanted to buy S&P 500. I pitch, we have a similar product, which is FCAM. It's not similar in a way that
but it's similar as in it's a core US.
It's a core US equity product. And he's like, oh, why not? I'll try it, right? So I think there is a value add of bringing something that's a bit more diversified, especially if you're doing it yourself. But yes, obviously our age, a lot of people are doing it themselves. And we said there's so many information online, so we get it also.
Yeah. And I get it. It's like it's the shiny toy thing too, right? It's like sometimes you hear about these things like, oh, I bought this thing because look, it was up like 30% in the last month. I'm like, oh, do you know why? Like okay, no reflection, just looking at past performance, but.
And most of the time, the platform will push you a portfolio, right? And this is even less valid. They'll push you a diversified portfolio, and then the value add, I say, look, we do have those products that are not necessarily pushed on the platform, and the difference is that we're not purely passive, that we also try to beat the market over time at a great price.
No, That's a good point. And you're right. It's a simple way out. So, but thank you for working on the golf course on Sunday, by the way. That's very, very nice.
Yeah, it's basically working.
What's the most common mistake you hear people make when they trade ETFs? Like, I know mine, but I'll let you go first. But like, I'll add something if needed. But I'm
guessing we probably have the same one. The biggest mistake is placing trades overnight, in the morning, at night, at market, just waiting for the market to open. People, advisors or brokers placing trades, like if it was a regular pack on a mutual fund.
Yeah.
It's not exactly the same product. So, if you place a trade, even if it's a smaller trade, like a $25,000 or $50,000 trades, it will still go directly to, it's not just like us wrapping the mutual fund together and us taking the liquidity at the end of the day of every person within that fund. You will have your own liquidity for your specific ticker. So that would be the biggest error I would see people placing trades, at market, early in the day or later in the day. I don't know for you what you think, but I think that would, and the order books are not necessarily fully filled at that time.
You know what? I think that is number one, but the number two is just, okay, yeah, so I don't want to put a market order, but then putting the limit order on the market price and not the bid or the ask, right? So you just sit there for hours just looking at it. It's like, why is this not working?
That's true.
So and that's similar for a stock though. It's like same thing. It's like, you want to buy a stock, you got to put it on the ask. If you want to sell a stock, you put it on the bid, and it's unfortunate, and you're going to get there's a spread involved, but way of the world, unfortunately.
It's like going to a currency counter at the airport, and asking for the price they're selling instead.
I want the CAD to USD at par, please.
Which I don't think the person behind the counter will do that for you.
No, but I don't think so. Last question. It's kind of more of a fun one. You're from Montreal. You've lived. You spent a lot of time up north in Tremblant.
Yeah.
West Island also lived.
West Island, bit everywhere.
This place quite well. For anybody listening that's coming to Montreal, what's your favorite restaurant?
I've been out for 3 years now. So I will mention. So
okay, then do an honorable mention for favorite one in Quebec City.
I'll do that. And actually, Michelin star restaurant. Michelin just went to Quebec City and had more Michelin star restaurant in Quebec City than Montreal. So Quebec City have great restaurant. The one I would there's a bit of beef here between Quebec City and Montreal. I'll defend Quebec here. They have great restaurant. Batuto would be one great restaurant in Quebec City at a reasonable price. The one that just won them 2 Michelin star actually is La Tanière in Quebec City. Great restaurant. In Montreal, just came back. Stuff changed obviously in 3 years. As you know, restaurants, it's a tough business. They close and they reopen. But the one that I've always liked, and it's still open, is called L'Express on Le Plateau.
Okay.
It's a pure French bistro.
Okay.
You feel yourself like you're in pure Paris. Obviously, there's a line. People would say the language, everything, but like even myself as a pure Quebecer, Canadian, going into that, I'm like, oh, I feel like I'm in Paris. It's and the food's great.
I've literally never been.
It's a great restaurant. It's Express, and it's open until like 3 a.m. also. So like you can show up at 12 p.m. and have a great meal. Okay.
Wow, I love that. That's great. Great insights. Yeah, I'm doing this selfishly for me actually. So
exactly.
Okay, that's pretty much all I had. Any last things you wanted to add, or
No, I mean.
Thanks for coming on.
Thank you. We're in a growing business. Business of ETF in general in Canada is going. I mean, I don't think these numbers would have made sense 1 or 2 years ago, right? And Fidelity's getting on the wave right now, and with a product that's a bit different in the industry, so we do have our little value add there. But yeah, super interesting. I just joined the business, the ETF officially business 3 months ago. So I think
you've been working with ETFs for years, 7, 8 years, right?
But the pure to be more concentrated on this product in the short term, and there's the reason why I switched over is because I think there's going to be tremendous growth over the next few years.
Well, we're very glad to have you. And we'll wrap up the show with that. Thank you very much for joining us. The first episode of Ticker Talk. We're going to come at you once again, monthly episodes. Going to bring in a bunch of great different guests, answer your questions. So please subscribe to our YouTube channel. You can listen on your favorite podcast app. Thanks for joining us. Until next time.